So I would say get gold above 1950 if you're waiting for some level of confidence to enter, and silver back over 25. Not the highs of the year, which were above 26, but get back over 25 again. And at that point, I would assume if you're not in, you better be in. And I think the temper and tone of those markets, gold, silver, and the miners, which are definitely a languished, lagging sector to gold, they always underperform on the downside. And there's points in bull trends where they vastly outperform, and which we expect this time. If silver gets back over 25 and gold over 1150, I think I would focus at that point on miners and silver. Gold's the mama, but I think I would focus on silver and the miners for better percent performance.
In a recent interview with Liberty and Finance, renowned momentum structural analyst Michael Oliver of OliverMSA.com shared intriguing insights. He suggests a potential shift in the financial landscape. If major bank stocks continue their decline, the Federal Reserve might be compelled to reverse its policies. This could favor gold, a safe haven asset. Oliver proposes when gold surpasses $1,950 and silver climbs back above $25, it's an opportune moment to consider investment. Moreover, if silver exceeds $25 and gold crosses $1,150, allocating focus towards silver and mining stocks could yield superior returns. Current market dynamics reflect this perspective. Spot gold witnessed a modest 0.2% gain, reaching $1,892 per ounce. Although the metal's price has rebounded from mid-March lows, it is on track for a fourth successive weekly decrease due to concerns surrounding prolonged elevated interest rates by the Federal Reserve. Correspondingly, silver rose 0.6% to $22.82 an ounce. Just before you watch the Michael Oliver's interview and learn more about market trends, consider subscribing to our channel and give this video a big thumbs up. Oliver discerns a critical juncture when silver surpasses $25. Such a move could signal an imminent robust uptrend, aligning with expectations that project silver trading at $23.24 per ounce by the quarter's end and a potential rise to $24.98 in the coming year, according to Trading Economics macro models. Offering further insights, Daniel Hines, a senior commodity strategist, emphasized the supportive backdrop for gold. Hines noted the possible end of the Federal Reserve's tightening cycle, a weakening U.S. dollar, and looming credit constraints as conducive factors for gold. This echoes Oliver's viewpoint of a conducive environment for gold investment.
It's always an important thing to get in at the right point on a long-term trade. Our entry point for gold, after being bearish from 2012 through 2015, was a couple months off the low in February of 2016 at $1,140. That was our primary buy for our subscribers. We had a secondary buy after that 2012 flopping around action. 2018. We'd had a recovery off the 2015 low, then we waffled and gold went back down into the lower 1200s. The upper 1100s. And when it came up out of there, we issued a second major buy. When the gold market went down through the lows of the range of 2020 through 2022, the low end was 1675. There was a clear floor. It broke that last summer. When it did, we declared that would be a bear trap, meaning it's false. It won't sustain. When it aborted back above that low, it made the low in September, and October, November was roaring back up and rushed to the highs within a matter of a quarter or two. We issued another buy signal. So entering gold now, if you're a trader, you're late, and realize you're late. So your risk is going to be higher. But if I had to say right now, if you're not in it and you suddenly want to get into gold, then the pullback that we've had, a very protracted multi-month pullback, mostly redundant, up, down, up, down, up, down. The other day, we made a marginal lower low than we did in June. We actually nipped under 1900. Didn't bother me. Bothered a lot of folks. We think that the time spent on the downside is now near exhaustion on the clock. And there's certain measurements we have for defining the clock. You get much of an uptick here, like even, back over 1950 again. I would write it off. It's over. We're going back up again. There's going to be a rush. Silver has a level. Now, its rally this year got up above $26. Remember, its low was near 17 last September. It rushed up to over 26. Right now, we're trading either side of 23 today. I think we traded over 23 at one point today. You get back over 25 again, assume white knuckle fight is about to begin, that we're going to rush again. So I would say get gold above 1950 if you're waiting for some level of confidence to enter, and silver back over 25. Not the highs of the year, which were above 26, but get back over 25 again. And at that point, I would assume if you're not in, you better be in. And I think the temper and tone of those markets, gold, silver, and the miners, which are definitely a languished, lagging sector to gold, they always underperform on the downside. And there's points in bull trends where they vastly outperform, and which we expect this time. If silver gets back over 25 and gold over 1150, I think I would focus at that point on miners and silver. Gold's the mama, but I think I would focus on silver and the miners for better percent performance.
Oliver spotlighted the Federal Reserve's intriguing behavior, emphasizing their often sluggish response to economic shifts. What's even more intriguing is that the Fed's rate cuts, those tools we often hear about, might not always wield the magic wand for the stock market's well-being. Recently, the people from the Federal Reserve had a meeting, and they talked about raising interest rates. This made the stock market on Wall Street go down a bit. At the same time, the price of gold was around $1,900, which is an important point. Oliver says if the stock market, which has been trying to recover for about a year, starts declining again, gold could benefit. Oliver thinks the Fed might print more money to help bonds and stocks, which could benefit gold. But gold prices struggled to stay above $1,900 in London on August 17, 2023. They ended $5 lower due to falling stocks and bonds. The dollar's strength also pushed gold's price down to $1,890, which is the lowest since March. Oliver also compares the price movement of gold to that of Citicorp, a large bank. He notes that both gold and Citicorp have been having trouble moving significantly from their highs and lows. Let's get back to the interview.
And gold is a leader market. It doesn't wait for events to happen. It anticipates them. After all, it's been around several thousand years. You name me a market that's been around that long, okay? It's held its value for millennia, okay, against government degradation of money, okay? Okay, now, what we have is the topping of the stock market early last year by our metrics. We said, that's it, that the market is making a major top. Now, we did this in year 2000, in January, and the market labored around and even made a marginally new higher high later in 2000 and then collapsed. It did it in 2007. It topped. We knew it was topping in late 2006. We said it was topping in late 2007, and it fell apart by late 2008 with counter-trend rallies. But the stock market was incredibly stupid at each of these highs. It never realized it had been a bubble. This time it's the biggest bubble in U.S. stock market history. 7-fold increase in S&P, 16 in NASDAQ 100 over a span of 12 years. Created by excess monetary policy, free money, false cost of price of money created by government. Errors were made over many years and with great dimension. Not only government errors in spending and planning, but corporations, family planning, all these things were effectively hallucinogened by injections from government monetary policy. Okay, I just mean the Fed. They're stupid. They're always lagged to reality. You can go back and look at history of their rate rises and then their rate cuts when they occur. Okay, if they go on a rate cut policy now, it's not going to help the stock market. It didn't help in 2007 through 2008. They cut rates like crazy. They cut rates starting in January of 2001 all the way to the bottom. Market still went down. So when they start to cut rates because they get vibes and phone calls, no doubt, behind the scenes from major banks, they're going to get concerned. They're going to plateau. They're going to do the pause. Okay. And everybody thinks, oh, that's good for the market. No, it's not, because it's acknowledgement by the Fed that something is amiss. The beneficiary of this, again, will be gold, because they'll go back to a policy of monetary excess to defend muni bonds, U.S. government bonds, and the stock market. Unfortunately, a lot of gold bugs and who are depressed all the time now, the last 2-3 years, because it's stalled, which is really the fact. It's not gone down, it's stalled. They don't recognize that gold is not directly correlated to the direction of interest rates in the stock market. They seem to think that if the stock market goes down, oh, that means, quote, deflation, and it means gold will go down. And if rates stay high, gold's going to go down. Well, throughout history, this is not true. What gold is watching right now, I think very closely, is it's watching the stock market. Because when that stock market finally rolls over from this secondary rally effort that it made for the last, well, actually 12, 13 months since the lows of 2022, try to get back up to the highs, couldn't do it. And I suggest to all your viewers that they go on their quote screen and punch up, for example, Citicorp. And I suggest you take Citicorp and put it underneath your gold chart, as I've done here, and you'll see their inverse. In fact, you can see it very clearly on this price chart. It's not been the type of drop that gold had in 2020, when it dropped from 2,000 and went down to 1,600 something, went back over 2,000 again, then dropped down to low 1,600s. This time it went over 2,000, and gold for 5 to 6 months now is dawdling. Its percentage pullback from its high, the high monthly close in gold was 1999 this year, new all-time high monthly close, just below 2,000. Well, we're trading right now about 1,900. 5 months later, off the highs of the year, and we've given up, 5%? That's the same as Citicorp. It couldn't get off of its lows recently, just like gold can't get off of its highs. So I think if you're going to look at a market that might be a perfect mirror image of gold, watch Citicorp. And you can bet that the Fed will be concerned if Citicorp melts through those lows.
As major bank stocks teeter and the Federal Reserve contemplates its policy course, the spotlight is on precious metals like gold and silver. Will the Federal Reserve's policies shift in favor of gold, as Michael Oliver suggests? Let us know your thoughts in the comments. If you liked the video, please subscribe to our channel, and currently, 93% of viewers haven't subscribed yet. Help us reach 2,000 subscribers.